thinking about long 30 delta scramble. So the Bitcoin was pushing toward resistance near 67,000 to 68,000, and on the surface short calls looked obvious. But when implied volatility had already risen from an extremely depressed level of 7 to about 19, the IV percentile. So the more important question now is it's not direction, it was the direction. Because I'm thinking that if I short the calls position now, maybe the IB is keep elevating in the next few days, so I'm not so certain to short calls up to this point for today evening. Meanwhile, the other assets, the oil price look extended. Bitcoin was firm as the oil price has rebounded out from around 70 to 84. The gold price has recovered as well. The SPY was still hesitating near the all-time highs. So if you look at the chart, selling upside premium might make sense because the Bitcoin is still near the resistance level, but it did not show any breakout yet. So that's why I want to skip the short calls. And along with that, because the IV is just started to rebound from the lowest level, so I decided that I will use about a quarter of my intended budget, the risk budget, premium budget that I wanted to long the 30 delta strangle with about 45 days expiry. Okay, so let's go back to the chat. Yeah, so this is what I just described. We see that the gold price has rebounded well today. It has rebounded from the 4,000 level. A strong supporting force from the 4,000 level. The Bitcoin here, 66,000 now. It almost reached 67,000. The SPY still near the all-time high zone. Meanwhile, the oil price has rebounded from 70 to 85. Just a quick look to my current position. The short position I made a few weeks ago at the 4,200 is still in the money with 650 in profit. But I expected that the gold price will show a deeper downward move. So now the price has rebounded from 4,000 up to nearly 140.80. So this is still the point that I will not trail the stop because I don't want to find the entry again. And overall analysis is that the price is still under the short pressure. So tomorrow will be the important day to see if the price can going up further. So now I will place my long position in the straddle. Now I want to go for the long straddle. Sorry, the long strangle. So I will go for the expiration date of around 37 date expiration. Let me check if I should buy longer. 65 day. Let's see the price. around here. This is delta about 34. So this is where I'm looking for. The strike price is 72,000. Okay, so I'm done. Already to long the strangle. 35 delta strangle. Lot size is 0.15 contracts. So I have spent a quarter of my risk budget for today. So let's see how tomorrow turns out to be. So the markets do not pay us for being plausible. They pay us for being positioned correctly when the distribution of outcomes starts to change. The key detail for me was not that the IVP was high. It was that the IVP had risen meaningfully off the very low base. So going from the IVP of 7 to 19 is still not expensive enough in absolute terms, but it's a real change in character. So after a long period of compressed volatility, the first move higher can be met more than it looks on the chart. To be a trap here, the IV can still stay low in this region before it really can spike up again. So this is where I don't want to bleed my premium from longing the strangle with the full size yet. And also that we can see that the IVP is not high enough. So that is why shorting for premium can become fragile. So the temptation is in a setup like this to say Bitcoin is near the resistance and therefore shorting calls. Yeah, but that is too simple. The real question is whether the market is still in a quiet and mean reverting regime, or whether it is waking up. Oil has rebounded, and the firmness in other risk assets and the rise in IV all suggested that the market might be transitioning. In that kind of environment, selling calls can mean shorting convexity just as the range begins to expand. I was also influenced by what I had already done earlier. When the IVP was extremely low at 7, I had flattened all the position. That mattered. It meant I had already recognized that the market has become too quiet to justify staying heavily exposed. So once volatility begins to reprice, it becomes reasonable to reconsider whether the edge is now in owning movement rather than selling it. So I choose not to force the short call trade. Instead, I allocated about a quarter of my intended budget. The full budget is $3,000, so I decided to spend about $750 into the 35 strangle with roughly about 45 days to expiry. So that was not a big expression of conviction. It was a controlled way to participate in a possible volatility expansion without overcommitting capital to one interpretation. So that is the lesson here. Long strangle are not automatically better than short calls. The lesson is that the trade size should match the regime uncertainty. If the market is compressing and then begins to stir, optionality may be more valuable than yield, but optionality is still a wasting asset. So the budget has to be limited and the time horizon has to be explicit. So I don't confuse resistance with free money. I track the IVP in the direction of change and not just the absolute level. Ask whether the market is stable or transitioning, the size of the trade, so that being wrong does not impair the position. Does not impair the portfolio. sometimes the best trade is not the most profitable one on paper. So it is the one that keep myself being flexible for the next regime. Thank you for listening for today. If you want to listen to more analysis, please subscribe to my channel so I also have more motivation to do such videos. Thank you very much.